Hi guys, today we are going to be talking about how to make money using options. Specifically, we are going to go through three must know option strategies if you really want to utilize the full flexibility of options and have it be a routine part of your trading style. In the previous video, we talked about why options are useful and we started talking about the basics of how to make money trading calls or puts. This video expands on it, explaining strategies that involve trading more than one instrument at a time. So be sure to catch up on the previous video if anything seems unclear here. So let's start with our zero profit and loss line. A quick recap. Imagine this line represents you neither making nor losing money. Hence, it is where your profit and loss on your position is zero. The further right on this line represents a higher share price at expiry, and the further left a lower share price. Above the line, you are making money, below, you are losing. The simplest of today's strategies is very useful when you own a stock but you feel that it isn't really going anywhere or that it is going up very slowly and you would like to enhance the return it is giving you. Why even hold the stock, you may ask? There may be many reasons, one of which could be that you feel that the stock diversifies your portfolio in important ways. Anyway, let's use Amazon stock as an example today. Say the stock is trading around $3,400. You could sell the 6 month call option strike 10% higher or 37.40 for around $170. If in 6 months' time Amazon is still trading at 3,400, you keep your 170. If you had to do it again for another 6 months, you could earn $340 or 10% for the year while the stock did nothing. A 10% return on something that did nothing is fantastic. The stock price could go up, of course, ending above your strike in 6 months. As a result, the market exercises against you, forcing you to sell your Amazon stock at 37.40. However, in 6 months, you have just made the $340 the stock move plus the $170 option premium, giving you $510 or 15% from your initial $3,400 level. Yes, you no longer get to participate in further upside of Amazon stock, but a 15% return in 6 months or 30% annualized is a fantastic return. If you can regularly replicate this, your portfolio is doing very, very well. If you like the video so far, please give it a thumbs up and consider sharing it or subscribing to the channel. Also, please leave a comment. I would love to hear what you think or if you would like me to expand on something in particular in the future. In the case the stock actually fell, the $170 earned goes a long way in subsidizing any losses. This is another way professional investors often take profit on some of their positions. Say a stock you were holding just had an aggressive rally. Instead of selling out of the position, you can just sell a call at higher levels. The market rarely goes up in a straight line. A large rally is often followed by a partial retracement. This way, you benefit on the rally and the retracement that follows, as the call option often decreases in value quite quickly when the market falls. Also, just because you were exercised on your option doesn't mean you can't participate in Amazon anymore. You could buy back the stock if you have a new view that the price is going much higher. Alternatively, you could just take your profits and if the price falls again, get involved at lower levels. This strategy is called a covered call. The negative exposure created by you selling the call is covered by the stock that you own, hence the name covered call. In short, if you are prepared to give up some of the upside to owning the equity, selling the call option allows you to enhance your return on an existing position. Moving on, in the previous video, we discussed buying and selling single options. When you trade an option without having any of the underlying, it is called a naked option. Buying options naked could lead to large rewards for large premium costs. Conversely, selling options naked exposes you to large losses. A way to mitigate some of the extremes of the exposure is to trade what is called a spread. Going back to our Amazon example, let's say you think Amazon is going to go much higher in the next 6 months. However, you think that buying the 6 month 3740 call for $170 is just too expensive. In addition to you buying the 3740 call, you could simultaneously sell a 4200 call for, say, $70. This gives a net cost of $100. This is 41% cheaper than the original 170. Even if Amazon went much higher than 4200 in 6 months, your initial investment of $100 still increased to 460 or 4.6 times. Still significant leverage allowed for using options this way. Buying and selling a call in this manner is called a call spread. In the case of puts, If buying a 3,000 put at say $125 seems too expensive, you could simultaneously sell a 2,700 put for say $63 for a net cost of 62. This put spread, which costs half as much as a 3,000 on its own, can be used to partially protect an existing holding of Amazon stock or used to benefit because you thought Amazon was due for more meaningful fall, but not a total collapse in the coming months. Similarly, if Amazon did end below 2,700 by the time a put spread expired, you would have made $238. In other words, your initial outlay of $62 of premium has increased to 238 or by 3.84 times. Still significant leverage in trading the spread instead of the 3,000 put on its own. I think let's leave it there for now. Today we learned the covered call strategy, what call spreads and put spreads are, as well as what is meant by naked options. Again, if you liked the video, please give it a like and consider subscribing. It really helps the channel.